So gold doesn't have to win the war against the US dollar. Gold doesn't have to demolish the treasury markets like some gold bugs suggest. All it needs to do is return to mean. If it returns to mean, demand for this asset class increases fourfold. One can only guess what a fourfold increase in demand would do to a commodity where increases in supply are extremely limited. And that's precisely what I think is going to happen and continue to happen. I don't own gold because I think it might go from 2,700 to 3,000. I own gold because I'm afraid it's going to go to 9 or 10,000. Gold prices usually rise when people are concerned about the maintenance of purchasing power in fiat currency denominated savings instruments. On a global basis, the world's reserve currency is the U.S., and by default, the world's preeminent savings instrument is the U.S. 10-year Treasury. So let's look at the arithmetic just around the Treasury. The first thing to say is that the current deterioration of the purchasing power of the U.S. dollars is measured conventionally by something called the CPI, the Consumer Price Index. And I would argue with you that the CPI is a very inefficient measure of the deterioration of the purchasing power of the U.S. dollar. If you believe the CPI, it would suggest that the deterioration, Julia, of your savings is progressing along at about 2.6% per annum. I think if you examined your own personal finances in the period, say, 2000 to 2025, a 5-year period, and you thought about how your health insurance premiums had changed, or how the price of your groceries had changed, or how, if you're a homeowner, mortgage interest rates have doubled, or if you're a renter, what has happened to your rents. When I run that same exercise myself, and by the way, I'm an old cheapskate who doesn't spend very much, I find that a deterioration of my purchasing power is more like 7.5% per annum than it is 2.6% per annum. Mm-hmm. I would urge your listeners to think about their own spending patterns and whether 2.6 represents the level of the deterioration of the purchasing power of their savings that they've experienced. If you use the CPI number, the arithmetic around the U.S. 10-year Treasury isn't bad. You're getting paid 4.5% a year in a currency where your purchasing power is declining by 2.6%, which means you're getting almost 2% real yield. If by contrast you use the 7.5% number, that is, you're getting paid 4.5 in a currency that's depreciating by 7.5, you're losing 3% a year. The concept of investing in a riskless asset, a U.S. 10-year Treasury, where your purchasing power declines by 3% a year, compounded over 10 years, is not very attractive. Let me restate that. It's extremely unattractive. And this is precisely the circumstance where gold does well.
Yeah.
And gold has done well.
Yes.
Gold has long been recognized as a reliable safeguard against economic turbulence. Its appeal lies in its intrinsic ability to preserve purchasing power, especially in times when fiat currencies falter under the weight of inflation and economic mismanagement. To truly understand why gold remains a cornerstone of financial resilience, it's essential to delve into the arithmetic that underscores its value. Globally, the U.S. 10-year Treasury bond is perceived as a safe haven asset. Offering a nominal yield of approximately 4.5%, it has become a go-to choice for investors seeking stability. On the surface, this might seem like a reasonable deal. However, the real story emerges when you factor in the deteriorating purchasing power of the U.S. dollar. The Consumer Price Index, CPI, claims inflation is hovering around 2.6% annually. If this figure were accurate, the real yield on a 10-year Treasury bond would be modestly positive, providing investors with roughly 1.9% in real returns. However, most Americans would argue that the CPI doesn't accurately reflect their lived reality. Rising grocery prices, escalating rents, and skyrocketing healthcare costs paint a far grimmer picture, suggesting that true inflation is closer to 7.5% annually. With this more realistic inflation rate, the arithmetic becomes starkly unfavorable for treasuries. Instead of earning a real return, investors find themselves losing approximately 3% of purchasing power every year. Over a decade, this compounds into a significant erosion of wealth, undermining the very premise of treasuries as a risk-free asset. This discrepancy highlights why gold becomes an attractive alternative. Unlike fiat-denominated assets, gold does not erode in value due to inflation. Its intrinsic worth remains constant, providing a hedge against the depreciation of paper currencies. While individual investors grapple with the arithmetic of inflation, central banks around the world have already drawn their conclusions. Countries like China and Russia have been aggressively increasing their gold reserves, signaling a shift away from the US dollar. This trend reflects both economic pragmatism and geopolitical strategy. China, for example, officially reports holding over 2,100 metric tons of gold, but many analysts believe the true figure is significantly higher. The People's Bank of China often acquires gold through discrete channels, bypassing international reporting requirements. This strategic opacity allows China to quietly amass gold while reducing its exposure to U.S. treasuries. Similarly, Russia has been fortifying its gold reserves as a shield against Western sanctions. With over 2,300 metric tons of gold, the country has positioned itself to weather economic storms without relying on the U.S. dollar. These moves by central banks underscore a broader narrative. The era of unquestioned U.S. dollar dominance is coming to an end, and gold is emerging as a critical pillar of the new financial order. Gold's value is not just a product of geopolitical shifts, it is rooted in fundamental arithmetic. Unlike fiat currencies, which can be printed at will, gold is a finite resource. Annual gold production adds only about 2% to the existing global supply. This scarcity ensures that gold's value remains relatively stable over time, even as currencies fluctuate. Moreover, gold's historical performance underscores its resilience. During the 1970s, a decade marked by high inflation and economic uncertainty, gold prices surged from $35 per ounce to $850. This meteoric rise reflected the metal's ability to preserve purchasing power in the face of a rapidly depreciating U.S. dollar. Adjusted for inflation, the 1970s gold rally serves as a potent reminder of the metal's role as a hedge against economic turmoil. While gold often takes center stage, silver offers a compelling complementary narrative. As both a monetary metal and an industrial commodity, silver occupies a unique position in the financial ecosystem. Its dual role means that it benefits not only from economic uncertainty, but also from technological advancements. The transition to renewable energy, for instance, has created a structural bull market for silver. Solar panels, which are now the largest source of industrial silver demand, are expected to drive consumption higher in the coming years. However, silver supply dynamics are challenging. Unlike gold, which is primarily mined for its own sake, most silver is produced as a byproduct of mining other metals, like copper and zinc. This makes scaling up production difficult, even as demand continues to rise. The arithmetic is clear. Gold and silver are not just hedges, they are essential components of a resilient financial strategy. The current economic landscape, marked by inflation, geopolitical tensions, and an over-leveraged financial system, underscores the importance of these precious metals. For individual investors, the time to act is now.
This part of gold isn't so much arithmetic as narrative, which is to say the preeminent buyers of gold in the last 3.5 years haven't in fact been Americans concerned about the deterioration of their savings, but rather foreign governments who object to two things: the weaponization of the U.S. dollar and the weaponization of the SWIFT banking system, which is to say the U.S. government's attempt to use the U.S. dollar to enforce its policy prerogatives elsewhere. Other countries object to that. And two, a return to that arithmetic. If you're China and you have $3 trillion in U.S. treasuries and you look at being paid 4.5% in a currency where the purchasing power is declining by 7.5%, it seems like a lousy deal, particularly when that's compared and contrasted with selling your U.S. treasuries and using the money to make investments in your own economy. The Chinese, of course, have done both, made investments in their own economy and bought gold. And I think what you're seeing there is the hegemony of the U.S. dollar challenged, often in favor of gold. One final piece of arithmetic, Julia, which we talked about 3 months ago, but some of your listeners won't have had the good sense to listen to us 3 months ago. That is this: gold is really, really, really under-owned historically. JP Morgan Chase suggests that the market share of precious metals and precious metals-related securities is less than 0.5% of total savings and investment assets in the United States. In other words, an infinitesimal market share. The 4-decade mean market share is estimated by JP Morgan Chase to be 2%. So gold doesn't have to win the war against the US dollar. Gold doesn't have to demolish the treasury markets like some gold bugs suggest. All it needs to do is return to mean. If it returns to mean, demand for this asset class increases fourfold. One can only guess what a fourfold increase in demand would do to a commodity where increases in supply are extremely limited. And that's precisely what I think is going to happen and continue to happen. I don't own gold because I think it might go from 2,700 to 3,000. I own gold because I'm afraid it's going to go to 9 or 10,000. Why do I say that? The last time that we had sustained deterioration in the purchasing power of the US dollar was the decade of the 1970s. In that period, 1970 to 1980, back to arithmetic, sorry. According to the Office of Management and Budget, the U.S. dollar lost in excess of 75% of its purchasing power, which is to say, at the beginning of the decade, $1,000 worth of goods and services, by the end of the decade, would have cost you $4,000 to buy. During that period, the gold price went from $35, admittedly a price-controlled $35, to $850. And I think passes prologue. I don't see any reason, any way, with the on-balance sheet liabilities of the U.S. government at $36 trillion, and with the government's estimate of the net present value of off-balance sheet liabilities, mostly entitlements, Medicare, Medicaid, Social Security, exceeding $100 trillion. That is to say, with net government debt over $130 trillion, I don't see any way out of this circumstance other than inflating away the net present value of those obligations, just like the decade of the 70s. And that means likely, not merely higher, but much higher gold prices.
As we delve deeper into the current economic and geopolitical environment, it becomes increasingly clear that gold and silver are no longer just commodities. They are strategic assets with critical roles in a rapidly changing world. The implications of this shift are profound, affecting not just individual portfolios, but entire nations and their financial systems. The dramatic increase in gold purchases by central banks is perhaps the most underreported financial story of our time. These institutions have become the largest net buyers of gold globally, accumulating more than 1,136 metric tons in 2023 alone, a 55-year high. Why are these guardians of monetary policy rushing to stockpile gold? The answer lies in both economics and geopolitics. For decades, the US dollar has been the backbone of the global financial system, supported by its reserve currency status and the deep liquidity of US Treasury markets. However, this system is showing cracks. The weaponization of the dollar, using it as a tool to enforce foreign policy, has alienated nations like China, Russia, and even long-standing allies. By freezing assets or denying access to the SWIFT system, the US has inadvertently accelerated the global de-dollarization trend. Gold is emerging as the natural alternative. Unlike fiat currencies, gold is a tangible asset with no counterparty risk. It cannot be frozen, devalued, or printed into oblivion. Central banks recognize this, and their buying spree reflects a strategic shift away from dependence on the dollar. The BRICS nations, Brazil, Russia, India, China, and South Africa, are leading the charge to create a multipolar world. Collectively, they account for over 40% of the global population and nearly 25% of global GDP. More importantly, they are actively working to reduce reliance on the US dollar. At the recent BRICS summit, discussions included the creation of a gold-backed digital currency for trade settlement. While this proposal is still in its infancy, its implications are enormous. A gold-backed BRICS currency would undermine the dollar's dominance by offering a stable, non-fiat alternative for international trade. For countries wary of US sanctions or economic coercion, this could be a game changer. Even if the currency takes years to materialize, the mere prospect of it has already spurred demand for gold. China, for example, has been quietly accumulating gold through opaque channels, often bypassing international reporting standards. This stealth accumulation highlights the seriousness of their intent. The U.S. national debt recently surpassed $36 trillion, a staggering figure that underscores the unsustainable trajectory of fiscal policy. Servicing this debt becomes increasingly difficult in a rising interest rate environment. The Congressional Budget Office projects that by 2031, interest payments and mandatory entitlements will consume 100% of federal tax revenue. This leaves no room for discretionary spending without further borrowing, creating a vicious cycle of debt and inflation. Inflation is the silent thief of wealth, eroding purchasing power over time. While the Federal Reserve targets a 2% inflation rate, real-world data often tell a different story. Essentials like food, housing, and healthcare have seen price increases far exceeding official CPI figures. For savers and retirees, this creates a pressing need to preserve wealth in assets that can outpace inflation. Gold and silver fit this bill perfectly. Unlike fiat currencies, they are finite resources with intrinsic value, making them effective hedges against the erosion of purchasing power. While gold often takes the spotlight, silver's unique properties make it equally compelling. As both a monetary metal and an industrial commodity, silver benefits from a dual demand profile. Its role in renewable energy technologies, particularly solar panels, has created a structural bull market. The International Energy Agency projects that solar power capacity will triple by 2030, driving significant demand for silver. However, silver faces supply constraints. Unlike gold, which is primarily mined for its own sake, most silver is produced as a byproduct of mining other metals like copper and zinc. This makes it difficult to ramp up production quickly, even in response to higher prices. The result is a tight market where demand consistently outstrips supply. Over the past 4 years, global silver demand has exceeded annual production by an average of 20%, depleting above-ground stockpiles. This dynamic sets the stage for a potential price explosion. One of the most exciting developments in the precious metals market is the integration of blockchain technology. Tokenized gold and silver allow for fractional ownership, increased liquidity, and enhanced transparency. Imagine owning a fraction of a gold bar stored in a secure vault, with the ability to trade it instantly across borders. This innovation democratizes access to precious metals, making them more accessible to retail investors. Blockchain also aligns with the broader trend of financial decentralization. As trust in traditional financial institutions wanes, decentralized systems offer a transparent and secure alternative. Tokenized gold and silver could become the backbone of a new financial system, bridging the gap between traditional hard assets and digital innovation. History often serves as a guide to understanding the future, and the 1970s offer valuable lessons. During that decade, the U.S. faced soaring inflation, geopolitical tensions, and a loss of faith in fiat currencies. Gold responded by surging from $35 per ounce to $850, a 2,300% increase. While the circumstances today are not identical, the parallels are striking. The U.S. government's reliance on inflation to manage its debt burden is eerily similar to the policies of the 1970s, with net government debt exceeding $130 trillion. When off-balance sheet obligations are included, the path of least resistance is to inflate away these liabilities. This creates a fertile environment for gold to repeat its historical performance. Investing in gold and silver today is not just a defensive move, it's a contrarian one. Mainstream financial markets remain enamored with equities and cryptocurrencies, ignoring the warning signs of overvaluation and systemic risk. This creates an opportunity for savvy investors to position themselves ahead of the curve. Gold and silver are not just hedges, they are tools of financial resilience. They offer protection against inflation, currency devaluation, and geopolitical instability. Moreover, they provide diversification in a world where traditional asset classes are increasingly correlated. For those considering an allocation to gold and silver, the options are plentiful. Physical bullion offers the most direct exposure and is ideal for those seeking tangible assets. Exchange-traded funds, ETFs, provide liquidity and ease of trading, but come with counterparty risks. Mining stocks offer leverage to rising metal prices, but are subject to operational risks. A balanced approach that incorporates multiple forms of exposure can provide the best of all worlds. As we look to the future, the case for gold and silver becomes increasingly compelling. The cracks in the fiat currency system are widening, and the global financial order is shifting. Central banks are preparing for this transition by accumulating gold, while nations are exploring alternatives to the US dollar. For individual investors, this is a wake-up call. The financial system is at a tipping point, and those who fail to adapt risk being left behind. Gold and silver offer a proven solution, providing both stability and opportunity in uncertain times. In conclusion, gold and silver are not relics of the past. They are essential assets for the future. As the world navigates the challenges of inflation, debt, and geopolitical uncertainty, these precious metals stand as beacons of stability. Now is the time to embrace their value and secure your financial future. Whether through physical ownership, tokenization, or strategic investments, gold and silver offer a path to resilience and prosperity.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.